All right, everyone. Well,
Awesome.
thanks here for joining the joint Pioneer Capital Advisory Calder Capital webinar. So in today's webinar, it's with Ben on the buy side team, as well as Aidan and Sam from Calder, and then myself, Matthias with Pioneer, and my colleague Rafael, my head of sales. And we're going to be talking about how individual buyers can compete in a very saturated market. So basically, with all these folks trying to get into the business buying landscape, how you can truly stand out and differentiate yourself. Ben, feel free to kick us off here and pivot to the next slide.
Yeah, I'll let Sam actually say something real quick.
Yeah, absolutely. I just wanted to quick say as well, welcome. Of course, we've got the Calder team, we've got the Pioneer Capital Advisory team as well. Calder is in the business of helping buyers acquire business, and Pioneer is in the business of helping finance them. And as Matthias said, there's a lot of buyers out there looking, and it can be very easy to get lost in the shuffle, to lose out on competitive processes, to fail to really get any traction finding your own leads. Our goal today is to help you understand how to do some of that. Whether it's something you work with us, work with Pioneer, or do on your own. We want to give you the tools and some of the thoughts and strategies. I would also just say we're entering an interesting time of the year. The end of the year tends to be a period of reflection for a lot of owners. So, they're questioning, do I really want to do this another year? They're asking themselves, how does the outlook for the business look like? And, overall, a lot of, I think individuals are having those same thoughts. Do I want to continue in my role, in my W-2 role, or do I want to maybe take the leap and go into business ownership for myself? So it's an interesting time. It's a great time to be prospecting. October, we actually had our best month ever in terms of generating leads. And I'll be posting a short monthly recap video on the Calder site shortly. But I just wanted to say one other thing before we jump in, which is if you're looking to acquire a business next year, you really got to start today. Um, it can take anywhere from 8 to 10 months on average to get a deal done from the time you start searching. So just something to keep in mind as we go through this as far as the timeline goes. But Ben, I'll turn it over to you.
Yeah, thanks, Sam. We'll just start by showing the different positions of the people that'll be involved. Today's webinar, Sam, myself, Aidan, and Matthias on the Pioneer team, and Rafael as well. Appreciate everyone joining. Matthias, I'll let you walk through what we're going to be talking about today.
Yeah, appreciate it, Ben. So we're going to first kick off with an overview of Calder Capital, how they help business buyers with finding acquisitions. Then we're going to pivot and talk about how you as a business buyer can stand out in this ever crowded market with all these different folks that are trying to get into ETA. And then we're going to pivot to a Pioneer Capital Advisor overview, talk about our team, how we work with business buyers that are looking to get financing, primarily through SBA 7A financing. Then we're going to talk about the financing process and what to expect in that, just from a tactical level. And then we're going to talk about 4 different ways that you as a business buyer can really focus on building credibility to stand out with sellers. And then we're going to talk through 2 different case studies. One is a client that both Calder and Pioneer worked on together, Brian Hoek. And then the second one is a client that Pioneer works on that Calder wasn't involved on, Anika John. And then we're going to lastly wrap up with 5 different keys of success on how to go through the deal process. Ben, feel free to pivot to the next slide. We can dive in here.
Yeah, absolutely. And just if anyone has any questions throughout this, just feel free to put them in the chat, and then towards the end we'll wrap up with some Q&A. So definitely feel free to share some questions. But just to start off with, so Calder Capital specializes in both sell side and buy side advisory. Primarily, we have completed transactions in the industrial, construction, manufacturing, and distribution sectors. Enterprise value anywhere from 1 to 100 million, but we've done a majority of our transactions in the 1 to 8 million enterprise value range. We have advisors positioned all across the US, which gives us an advantage of having boots on the ground in those geographies, And then, if needed, those advisors are able to work within the different region that they're located. And so whenever we do have a client that might be in Texas or in Florida, we've got an advisor that we know we're going to hand select and choose to work with that client. So Calder's team's roughly 55, 60 members right now. 25 are buy-side specific team members, and then we have a pool of 20 advisors that work on the sell side and the buy side. So those advisors are experts in getting deals done, working with different professionals, and just ultimately, completing those transactions. Primarily, our buy side offers full service support. So this includes the sourcing of off-market leads. We're primarily doing that through direct outreach to business owners. So, going through brokered processes is something that we will do for our clients, but it's something that we found that the value of the off-market leads and introductions we made for our clients far outweigh, going through multiple different brokers. Over the last 3 years, we've done over 30 transactions, almost $160 million close to date. But yeah, I think I'll pass this back over to Matthias, give a brief overview of Pioneer.
Yeah, thank you, Ben. So Pioneer Capital Advisory, so we are a firm that's focused primarily on helping business buyers get access to capital through the SBA 7A loan program. More recently, we've also started working on non-SBA financing. And so Rafael is actually part of a team of two different individuals at Pioneer that's helping on independent sponsor financing. So we currently have two different engagements going simultaneously there. But speaking from the SBA side specifically, so we started back in May of 2022. My background is working in SBA 7A lending, was at Byline Bank and Live Oak Bank, two of the top SBA banks, and then two banks in Wisconsin. And so 3.5 years ago, I started Pioneer, and we've helped business buyers, 115 of them, close just over $250 million of SBA 7A financing in the last 3.5 years. And year to date, we're at about $105 million of SBA 7A loans, and we're currently expected to close another 74 million, well, 60 million by the end of the year, potentially, knock on wood. And so where we really kind of help you as a business buyer is with finding out first and foremost, is the business that you're looking to buy SBA eligible, figuring out what subset of banks are going to be a good fit for it, and then helping you truncate and speed up the process of going through underwriting and closing by basically front-loading the closing process into the underwriting framework to help you go faster through the process. Rafael, any words that you'd want to say here on the overview?
No. I think you cover everything, Matthias. Thank you.
All right, Ben, let's go to the next slide. So here's our lean but nimble team. So we're built verticalized just like the top SBA lenders. So we have a sales pod, which consists of Rafael, who's on this call, our head of sales, as well as Alan. Then we have myself and my chief operating officer, Valerie. So combined, we've worked on probably about $750 million of SBA transactions. We each have about a decade of experience in the SBA space. We have a head of closing operations, Andrea, who starts working with clients at the time they go into the underwriting process to help them with getting a head start on the post-approval closing side. Pablo and our team is working on go-to-market strategy in the non-SBA division. And so he currently has two engagements that he's working on. And then we have a credit or analyst team that's Ramiro, Fernanda, and Amari. And so they work on preparing lender pitch decks for banks to help with presenting deals in the most bespoke and accurate way possible to get good credit terms. So that's this slide here.
Perfect. Yeah. And then this slide here is just to give you guys a better understanding of what we've picked up on over the years of working with so many clients, on what we've seen, how people can separate themselves from the crowd and stand out as a buyer. So the first one being obviously building credibility with these business owners, right? Why should an owner sell their business to you? It is very common when people inquire to these companies about a potential sale of that business. So, these inquiries these owners are getting are very common. So wherever we can stick out, and stand out from the crowd, it is very important to do so, right? And then that leads to the industry knowledge. The more you can demonstrate to that business owner, the more you understand about the industry, and that owner can then see yourself running that business moving forward. That will definitely lead to you standing out from the crowd as a buyer. And then finally, getting to an offer with speed. It is very important to first obviously get an understanding of where the owner's heads might be at in terms of an offer. And then once we are to confirm that we are in the same ballpark and that, both parties are interested in proceeding with those conversations, it is very important to keep the momentum going and move quickly to an offer. And that transitions into credible LOIs are obviously taken very seriously. A well-constructed, realistic LOI signals commitment to the owner and dramatically increases the buyer's possibility of closing on that deal. And with that, I'll pass it back over to Ben.
Yeah, thanks, Aidan. I wanted to touch on credibility as well, just why it's so important for these business owners. In general, they're going to see anywhere from 2 to 3 LOIs in the course of their lifetime for their business. And a lot of these business owners, they see their business as a child, as an extended family. And so when you're making decisions about your business, you're only going to be actually having serious conversations with people that you have the utmost confidence in and that are, presenting themselves as credible, knowledgeable people. And so, at Calder, we try to present our clients as the most credible buyers, the ideal fit for a lot of these business owners. And the way that we do that is by creating marketing material and having an elevator pitch for our clients. So we're going to showcase some marketing material on the next slide, but we just create a personal and a buyer profile that we use to instantly build credibility with these business owners. And then also having an elevator pitch for our clients. So this is something that you guys can do for yourselves, but just having a brief 1 paragraph elevator pitch about yourself, but then also tie in why that business is the one that you want to specifically acquire. This kind of ties into the growth plan and industry knowledge, but if you're talking to a business owner, ideally you've done a lot of research on that business, on that industry, on that market, whatever geography or region you're in, because each different industry is going to have nuances. And so if you're able to talk to a business owner about those specific nuances that business owner most likely thinks not too many people can actually, have a conversation with them about it, that's going to help build your credibility. And then with the growth plan, depending on how your deal is structured, there could be incentive for this business owner to, continue to help you grow the business. Now, ideally, the business owner is helping you grow the business post-acquisition, whether that's in a transition plan or in an earnout or profit sharing type of structure. This type of deal structure, one, it bridges gaps on valuation, but two, it also incentivizes a smooth transition of ownership. So being able to, one, speak to the business owner about that growth plan ahead of time, but then two, talk about how you're going to collaborate with the business owner and actually grow the business. Because a lot of these business owners, they may, be slightly more risk adverse after owning the business for 20, 30 years. And so they're looking to take some chips off the table, and they're willing to potentially partner with someone that can help them receive and see a second exit. So if you're able to just have that conversation, that's going to build credibility. It all starts with being prepared, and actually having some understanding of that knowledge of that specific industry. And then lastly, just having a deal team ready. This builds a lot of credibility. At Calder, we find that a huge value we add to our clients is being that intermediary between the seller and the buyer. It takes out some of the emotion involved with continuously following up to request financials. I've got questions about this and this. And so if you have other professionals around you that are doing that for you, it allows for a lot more credibility. They think, wow, this person has already invested in acquiring my business. Maybe I should really, consider them as a serious buyer. And so that includes a financing advisor like Pioneer. Calder acts as a buy-side advisor for valuation, helping quarterback due diligence, helping with offer negotiation, deal structure. But then also, of course, you've got your attorneys, and then also an accounting firm for running a QOE. That's definitely important to ensure that all the finances are accurately tracked. So just having those key components, investing in those even beforehand, that is the risk of going into search, but it builds credibility. So those are sort of the solutions to some of the challenges that Aidan touched on. The marketing material that I mentioned, it's just that elevator pitch that I mentioned, that's sort of the top portion of the marketing materials, describes briefly what type of businesses you're looking to acquire. And then, a pretty good chunk of our marketing materials is about selling the client, getting the foot in the door, making the owner interested. Who is this inquiring about my business? Oh, they have some related experience. Maybe a conversation is worth it. And so just having all that prepared readiness. A lot of searchers have a website created. That's a good first step. But business owners don't want to have to do their own work to go find your website. Having something prepared that you can give them is definitely credible. And then on the financing side, I'm going to pass it back to Matthias to talk about the letter of support.
Yeah, and back to Rafael before we jump in on
Yeah.
this. Back to the deal team. I can't emphasize that enough. Having someone like Calder, a good M&A attorney, financial due diligence provider, you really want people that have worked on these types of deals before, because this is high stakes M&A, right? You might only get one shot at going under LOI, and having the right people can really make the process go a lot better, especially due to the fact that there's emotions run high. The seller's attorney doesn't always have the same motivations that your attorney or you have, and people can lock horns. So it's super important to make sure that you have the right team in place. Rafael, back to you on the letter of support.
Of course. Thank you, Matthias, and thank you, Ben. And not only having all the right team in place, but as Ben was saying, all the materials in place to really support you as a buyer and show that you're serious about the process. So on our side at Pioneer Capital, one of the things that we offer our clients on the pre-LOI stage is a letter of support. So these are pre-qualification documents that validate you as a buyer. So we're going to be reviewing your cash liquidity position. So here we have a minimum requirement of $100,000 in cash liquidity. Your credit score, so we're going to be looking for something above 680, and also validating your resume and your LinkedIn profile, just to understand your professional background and to see if you have management and P&L experience. So the idea here is once we have all this information, we issue that letter saying that we feel confident in you as a buyer, and that can really help you stand out in the process and show not only sellers, but business brokers and everyone involved that you are committed with the process. You have the financing resources to back up that transaction, and also a financing team like Pioneer Capital behind you to support. And that can be very helpful, especially in a very competitive market as we have right now.
And on the financial letter of support, we have an exhibit that includes anonymized deals that we've worked on by industry and transaction size, as well as bank lender ranking, just to give some street credibility to sell-side brokers and intermediaries. Since ultimately at Pioneer, we're a loan consultant or a loan broker, we're not a direct lender. But a lot of the times, generally, they are taken positively. And on the margin, we've seen that they've helped clients get deals under signed LOI.
Yeah. Not only under signed LOI, sometimes even to start and initiate a conversation, like have the door open. When you have that letter, it's usually, based on our experience, very helpful.
Awesome.
Matthias, if I may jump in,
Oh, sorry.
if I could just add one thing, I'm so sorry to interrupt, but going back to the resume or LinkedIn profile, I think it's understated how important that is to have that accurate, and even other social media channels that ties into everything in terms of building credibility. A funny story, well, not so funny at the time, but funny now. We once had a buyer that engaged us, and we were very close on the deal. We had already negotiated a lot of the price and terms, and for some reason, the seller felt the need to just do a little more homework, run a background check on our buyer. And for some reason, our buyer had listed as their LinkedIn title, nanny of none of your business. And that apparently rubbed the seller the wrong way so much to the fact that it broke the deal apart. So it's important to keep in mind, not just LinkedIn, other social media channels as well. We've even had it where if there's something very, very political on your social media, that probably isn't good. It has a chance to hurt you a lot more than help you. So just review that, make sure it's professionally uh, shown on all of your social media.
Yeah, and anything that
Yeah.
you can do to like even back to the Business Buyer website, which I think Ben or Aiden had mentioned earlier, Sam. Anything that you can do as a buyer to really give the seller peace of mind as much as possible that you have the wherewithal and experience to ultimately help transition their business from them to yourself, because it's not just the dollars and cents, but this is something that they've put their blood, sweat, and tears into building, and they want to know that you're the right person before they go into the process with you.
Yeah.
Absolutely.
So this is kind of a high-level overview of how Pioneer Capital Advisory works with clients that we're taking through the financing process. And so when we get involved and really kind of roll up our sleeves, so we'll do this stuff kind of in the front end as far as the financial letter of support. If you're a qualified buyer, you have great experience and good liquidity. But when an engagement would commence would be at the point in time you have a deal under signed letter of intent. And so from a high level, it kicks off with a signed letter of intent, and we would send you an engagement letter that essentially acknowledges the scope of work that we're going to be performing to take you through the start to the finish of the SBA financing process. And so the engagement letter has a built-in NDA in it that explains anything that gets sent to us gets kept confidential, only ever gets shared with the SBA lenders that we work with when we're sharing the deal, the data room, and the deck with them to get term sheets. And then it also basically outlines what we're going to be doing. So basically building a lender deck, putting the deal that we think, or the deal in for the banks that we think it's going to be a good fit for, and then helping to provide transaction support from the start of underwriting to closing, building the pre-closing checklist from our head of closing operations, Andrea, and basically helping to the degree possible between you and the bank. Once we have all the inputs needed, which is typically the financials for the business that you're buying, the signed letter of intent, the broker listing, your personal financial statement, something showing your credit score, your source and use, and all of those other items. At that point in time, one of our three analysts on our team will build a lender deck that basically tells a story of what is this company that you're buying, what is your background professionally as a buyer, why are you going to be the right fit for this company that you're looking to purchase. And then there's also a requested source and use overview, a debt service coverage overview that basically shows, based on the historical financials of the company and the proposed financing structure that you as the buyer want to take out, what would the debt service coverage ratios have been had the seller run the business with that financing structure. And then lastly, there's a macroeconomic overview from this third-party financial SaaS vendor that we have called Lumos Data that basically shows what's the expected likelihood the deal could default versus perform. And then once that deck gets done, we then pitch it to the subset of lenders that we think it's going to be a good fit for based on things like the debt service coverage, the industry, what part of the country the deal is in, what is the SBA financing percentage that you're looking for relative to use of funds, what is your post-close liquidity as a buyer, what type of management experience do you have. And so to give some data points, I mean, these banks range from everything from banks that want to see 10% of the loan amount as post-close liquidity on your personal financial statement to banks that might finance you if you have 3 years of experience of college. So right now, we're working with a younger investment banker who's 24 buying a several $1 million business. And so that's kind of the continuum, and that's kind of where we come into place. Rafael, I'll let you cover term sheets to closing here.
Yes, of course. So when we do this outreach that Matthias was mentioning, the idea is not only get back to you with the best term sheet we could find, but hopefully multiple options, because then we can give the buyer the opportunity to compare different term sheets and choose the lender you want to move forward with. So once you make that choice as a buyer, of course, and choose the lender you want to work with, that's when full underwriting process starts. It's a part of the process that the buyer will be more involved directly with the lender. You still have someone from Pioneer Capital team, overviewing the entire process, making sure that we are advocating for your deal, making sure you have all the documents in place. So for example, this is a part of the process where they're going to be requesting a business plan, 3 years of financial projections, that if our clients needs our help, we do have templates and guidelines that we usually share with them ahead of time. And one thing that we do in order to accelerate the entire journey and be as efficient as possible, we have a dedicated person to close your deal, and that person will be introducing to you during underwriting. So the idea here is to really anticipate all the documents and items we believe it's going to be required to finalize and close your deal once your loan is approved. And that way, put us always one step ahead of time, and we can have that closing as smooth as possible. So by doing that, we've been able to average a closing time of 75 days from the moment you have a term sheet signed to the moment that we finalize and close your deal, which can be which is relatively fast than what you normally see in the industry, which is around 90 days for SBA and even above. And we say from the term sheet because that's when it starts underwriting. But for just to give you as a reference, the first 3 steps are relatively fast. So usually we are able to put together your lender deck and do the outreach in 5 to 7 business days. But we are only able to really kick off everything through the collaboration with the buyer once we have all the documents required, and of course, depending on the complexity of the deal. But that's just like to complete Matthias' explanation, an overview of our process and how we help our business buyers navigate the SBA financing journey.
And one more comment there just before pivoting to the next slide is ideally, best case scenario, the client that we're working with is working on the post-approval list while they're in underwriting. Not always is it the case that people want to do that, but essentially, based on the schematics of the deal, is it a stock purchase with commercial real estate, business vehicle titles? Is it an asset purchase that's lease locations, liens on 3 houses, no vehicle titles? We have a pretty good discernment on what the bank will likely ask you for. Now, there can be changes in the commitment conditions because things can get added in underwriting, but the idea conceptually is to get a jump on those post-approval closing items so that once you're approved, basically, we have a data room folder that we can hand off to the closer at the bank to get a bunch of stuff crossed off the list to make things go faster. Let's go to the next slide, Ben.
Yeah, do you want me to?
Yeah, okay. You can go first, Rafael.
Yeah, so these are 4 ways to be a credible buyer. It's very similar and goes very in hand with what we were talking in this webinar. So the first one is responsiveness and strong financials. It's very important to be very committed with the process, has all your documents in place, and really shows that you're a buyer that not only can fulfill those down payments requirements, but shows post-approval liquidity as well. Willingness to be a reasonable negotiator. So understanding that we need to have flexibility and it's a give and take situation, not only between the seller, but then what that's going to translate into the lender appetite and what they're going to be willing to underwrite or not. So having that flexibility will also increase your chances to be successful. Invest in a strong team. So working with, for example, Calder Capital that can really bring you like the right deal and qualified deals, but also having a good M&A attorney in place that has a lot of experience with SBA transactions. Same for due diligence, and working with advisor like Pioneer Capital that can help on the financing side. And that way we can make the process less complex and avoid any type of unnecessary surprises and delays. And the 4th point, SBA eligibility, not only regarding the industry and how you're structuring your deal and your LOI, which is something we can support you, and we're always going to be advising you in that, but as we mentioned before, showing a strong credit score above 680, proper liquidity for down payment, but also for post-close liquidity. So, and this, it really depends on the deal size and the lender that we are working with. Some lenders, as Matthias just mentioned, can like to see something between 5 to 10% of in post-approval liquidity. Others will be more comfortable in a high 5 figures. So it really depends, and that's also why we are here to help you and to put your deal in front of the right lender. And of course, showing management and P&L experience and a clean background, because every lender will be running a background check on the buyer. So having all those things in place, it will really help you taking your deal to the finish line without problems.
And just to interject one more comment on the post-close liquidity, sometimes what happens, especially at these larger banks, is when loans go bad in their portfolio, there can be kind of knee-jerk reactions to changes in credit guidelines. And so our chief operating officer, Valerie, is in constant communication, typically at least monthly, with the banks that we work with to ensure that there's no big changes that are going to impact our clients, so that we know when we bring a deal to them, it's ultimately going to be a fit based on these things like the debt service coverage, experience, and post-close liquidity.
I would have one other note that's sort of just about post-close liquidity, strong finances, and this would be more so on the business side versus the direct financing side. But we had a client we were working with who was looking at a business. He actually had an accepted LOI on a business, and this was slightly above SBA lending, so a little bit over 8 figures. And the business owner asked to see some personal, financial statements. And our client was a little bit hesitant to share them because the business owner kept $1 million liquid in a business account at all times, because this was a very CapEx heavy business. And so it needed a lot of investments at any time that a machine broke or anything like that. So just making sure that you communicate and understand how much liquidity is needed post-close, and even on a yearly basis, is this an asset light business, asset heavy, and then just making sure that you're aligned with the business owner, because they may have $1 million in a bank account that they use, or some deals are high 5 figures like they said. So just making sure that your personal financials are in line with the size of business that you're looking to acquire.
All right, thank you guys. I'm excited to walk through a quick, case study or example. This was a gentleman we worked with over the last couple of years, and ultimately Brian closed his deal in March of this year. First off, this is a screenshot from the podcast Acquiring Minds. Definitely would urge you to check out Brian Hoke on Acquiring Minds. You can see his full podcast, full story, as well as a bunch of other acquiring. We've been blessed that Acquiring Minds has covered a bunch of other searchers we've worked with as well, and they get into a lot of granular detail on the deals, talking about deal structure, multiples, prices paid, financing. So something definitely valuable. But I want to highlight just a couple things about Brian's deal, and of course, happy to answer any questions. But number one is, at-bats are needed and should be expected. I think sometimes buyers engage us and expect this to be a very linear path to a successful acquisition, and unfortunately, it's just not the case. It is a numbers game to some extent. I hate to compare this and make an analogy with fishing, but if you do not have a hook in the water, you aren't going to catch anything. So you need to be constantly out there. You need to be constantly in front of owners. You need to be saying the right things and making offers. No one ever bought a business without making an offer either. Brian had 4, I know it says 3 here, but it was actually 4 broken deals before he was successful on the 5th, which is the business he ended up acquiring. And this jives a lot with our something we put on a slide earlier, which is on average, it takes 6 offers to get one signed and under letter of intent. And that doesn't mean 6 unique businesses, but that includes renegotiating and resubmitting offers. But it takes several at bats. You probably didn't marry the first person you ever went on a date with, right? So just be prepared and be ready, because it's easy for me to say that and for people to nod their heads, but think about falling in love with a business, getting your ambition, getting your hopes up, getting confidence in, hey, I'm going to make this work, and then that not happening. and then that same situation happening 3 more times to you, it is easy to say, but if you truly feel that, that is a hard thing to go through, and it tests one's perseverance. And kudos to Brian here that he stuck through the at bats.
Sam, I'm waiting for the counterexample of the one person in this webinar that did end up marrying the first person they dated. So there's always unicorns.
Right. There are exceptions, but yes, absolutely. Most of the time, risks. I think this comes back to the proper mindset. Going into business, I like to say, is controlled chaos. It's not a straight line. Things do not go 100% according to plan. And the biggest takeaway from this and strength with Brian in terms of understanding the risks is he was open. He was open to the type of business. He was a little bit more hyper focused on geography, but he was very open to the type of business. He understood it wasn't going to be, there was going to be rejection. And I think sometimes we have buyers that come to us looking for a unicorn. They have all these metrics about, the type of customer churn and the customer concentration and all these other things. And and they want a business that's absentee and can be operated remotely. I'm sorry, but those things just do not exist. And if they exist, they're probably not good businesses. And they're also not going to go for the lowest price if they are really truly that good. So just keep in mind, I'm not saying lower your standards or your expectations, but just have the expectation that this is a relationship building process. ROI on your investments, I think it's important to keep in mind. What is your time worth? Because if you're spending your own time doing your search, that is costing you something. It's costing you your time. Versus we do have a lot of buyers, and this would be Brian's case here, where he kept his day job. He was able to support his family and keep his day job and still go full tilt on a search because he engaged us. So keep in mind what your time is worth. Consider, hey, keeping your job if that helps support an investment in this process in terms of working with the proper deal team. The other thing I would think of is again, time relative to a multiple. So we'll get into, and we got into multiple times with Brian where he was real close with certain buyers. And of course there was a gap. We would have to go up or figure out a way with deal structure to satisfy somebody that wants to sell for a higher price. And oftentimes we'd reach a point where we didn't feel like we couldn't go up anymore. And our team regularly challenged Brian to think in terms of time. Okay, paying an extra $250,000 is a ton of money. It's not to be done lightly. But when he's pursuing a 1 million EBITDA business, truthfully, think of that. That is 1/4 of a year of owning that business. So is it worth the deal breaking apart? And what happens if another quarter of the year goes by? You would have just paid for that extra $250,000 just there if you had owned the business. So something to keep in mind. And then the last two I'll touch on real quick: building trust. We talked about this a lot, but some of the ways to definitely do this is getting in person. Getting in person is really hard, honestly, to fully evaluate and know what their business is like until you get in person, until you meet them and shake their hand, until you walk the floor and see the business. And that really helps make a big impact for the seller as well. Keep in mind, these owners, as much as you are evaluating them and their business to see if they're a good fit, they are doing the same thing to you. They are asking themselves, is this buyer really the best fit to carry on my legacy, the best one to take over my baby? So don't forego that. And listed deals, it can be tough to do that. When you go off market, which is what the focus of our buy side search is, you have the time and opportunity to build that relationship. So don't forego that. Don't overlook that. That will building that relationship means that your offer will be much better received. And frankly, we have gotten away with starting much, much lower. I don't want to say dare I say a low ball offer, but when you build a relationship, you can afford to negotiate harder because you've got some rapport. And lastly, differentiator. Think about, what will people remember about you? How will they remember feeling about you? If your first question, or one of your first questions when you start to interact with them, is, so what do you want to sell the business for? It's probably not going to work real well. And unfortunately, we've had some buyers that even after we've coached still are too transactional. Again, this is a relationship. Start off by just trying to understand who this person is and how they got here. You could probably start many of their introductory calls off by saying, so how did you found the business and how did you get to today? And then shutting up and being quiet for 20 minutes. And by the end of that, you'll know a lot more about the business and the owner's going to really like you because if you did any good job of showing active listening, they're going to already start to like you. Spend a little bit of time up front to research their business and ask some specific questions. It doesn't take long. It can take 10 minutes. And if you could even use AI. One time, I went to a meeting and I just asked AI, I just put the website in there and said, what are some good questions specific to this industry? Funny enough, I asked one of those questions and the owner said, his eyes lit up and he goes, man, that is the best question, and then he spent 20 minutes answering it. And frankly, I didn't even know what I was asking about. So I'm not saying fake it till you make it, but certainly spend 10 minutes or at least 2 minutes on AI figuring out the right questions. So to recap here, absolutely listen to Brian's deal. It's awesome. He was a local buyer for us, and it was not easy, but he persevered, and he is a prime example of someone that is able to get a deal done thanks to following and adhering to the best practices in a search.
Business owners love to talk about their business, Sam, and they love someone that's willing to listen and that's genuinely interested. That's not just, looking for a cheap deal. So let's.
One other comment there is if you listen to the seller talk about the business, when you're trying to decide how to structure the deal, oftentimes you can pick up on things that are important to the seller that really can help you put together the best offer possible.
Yep.
All right, so this slide here is talking about a former Pioneer Capital advisory client that closed back in the summer, Anika John. So Anika went from working at a corporate job at Amazon in California to buying a book publishing company in Michigan. And so one thing that a lot of people overlook in the SBA space is that $5 million of SBA financing is kind of the maximum amount that you can ultimately get to buy a business. And when you have really strong experience from a corporate leadership standpoint and or a very robust personal financial statement with great personal liquidity, there are a handful of banks out there nationally that will actually provide what's called pari passu financing. So essentially, they'll do $5 million of SBA 7A financing, and then at the same time, you'll also be able to get conventional financing, generally at the same terms, so same interest rate. If it's just a loan for business acquisition with no real estate, 10-year amortization. Sometimes there might be an origination fee depending on the bank, but in this circumstance, using the pari passu financing structure, Anika is actually able to buy a $10 million company. And so in this SBA space, if you're coming from a very high paid job, what I tell people that I'm talking with, clients of Pioneer and prospects, is given the fact you're taking on the SBA personal guarantee, you're going into an unknown, you want to be able to really maintain at least the status quo of what you're making from an earnings standpoint, if not improving, due to the risks involved with business ownership. And so she was able to basically buy a business doing just about sub $2 million of earnings. And so the multiple was, on the higher side, close to 5, but she was able to buy a company that had a great team involved, good sales pipeline, seller that rolled equity, and basically not having to step into a very, owner-dependent type company. So she travels back and forth between California and Michigan, has a general manager type person in place. And so just one thing to think about, especially if you're in a very capitalized position as a buyer, is there are banks out there that will do these types of structures. And she has a podcast episode on Will Smith's Acquiring Minds podcast. And then she's also been on the M&A Launchpad Conference podcast as well, and a few others. But just to kind of share that example here. And we're seeing lots of these pari passu banks really getting an appetite to do these types of deals, because even though the non-SBA backed portion of the loan, the conventional loan, doesn't have the backing of the government, the companies themselves are more transferable and less seller dependent. So they're actually less risky deals overall.
Great. Thanks, Matthias.
Thank you, Matthias and Ben. Yeah, that was quite the deal you guys got done there. So congrats on that great deal you guys closed with Hanukkah. But this slide here, we just wanted to highlight a few keys to success that we've picked up on from working with so many clients over the years. For the sake of time, we wanted to make sure we leave some time for some questions at the end. So I won't hit on all of these here, but the two I always like to hit on are having an open mind and also being persistent. Having an open mind, more times than not, we've worked with clients in the past that maybe, say, for example, they were kind of on the fence about taking an introductory call because that prospect, right, that business wasn't maybe a 100% perfect match for their criteria, but it was pretty close to being so. More times than not, those clients who ended up taking those calls ended up learning more about the business. They ended up falling in love with that business, and they ended up closing on that deal. So we have seen it is very worthwhile just having an open mind when it comes to looking into these different opportunities. And then finally, being persistent, with that example Sam just shared with Brian, it took many deals, many at-bats for him to get one, out of the stadium, right, to hit that home run. So just being willing to look into different opportunities, submit multiple different offers, and, at the same time, making sure you're fully engaged in each of those opportunities, it is very worthwhile, and it will improve your probability of success.
Thank you, Aidan.
We'll transition over to Ben and Matthias for some questions.
Yeah, we do have a couple questions in the chat. I'll do our best to get through them all, but just starting off, Matthias, so the SBA you mentioned has sort of a 5 million full loan amount. What is the lower bound and the upper bound, size of the deals that Pioneer works on, and sort of the advice that you've given out throughout this podcast?
Yeah, no, for sure. Great question, Ben. So the lower band of deals that we work on are typically ones where the loan amount is going to be about $1 million or so. And then the upper bound is basically anything that's compatible. Well, speaking from the SBA space, Ben, anything that the banks will do the SBA plus conventional structure will finance. So typically about $8 million of loan or lending all in, 5 of which would be from the SBA 7A loan, and then about 3 of which would be from a conventional loan. On the non-SBA side, not to kind of cause any confusion, the deals that most lenders want to see there typically start around $2 million of earnings or so, because that's typically the profile where these SBIC funds and non-bank search fund type lenders, non-SBA search fund type bank lenders will get involved in the lending mix.
Got it. Okay. And Raj, just sort of a base benchmark. So typically maybe a 3 to 4 times multiple might be common with a 1 million EBITDA business. And then as Matthias mentioned, for Anika, that was closer to a 2 million. So that was closer to a 5 times multiple. So your question was in reference to revenue and EBITDA. So you can kind of work backwards.
And Ben, just to add to that, deal structure matters quite a bit when it comes to multiple. A lot of people talk about multiples as if every deal structure is the same, like, oh, it's always a 3 to 4 times multiple. I mean, deal structure can matter a whole bunch because we even have a couple deals right now where the multiple on paper probably looks high, but the deal is 100% seller finance. I'm kind of shocked at how many we have. I think 3 deals right now with our buyers that are 100% seller finance. They are or where there's just a small chunk of cash at closing, literally just enough to cover the closing costs of the seller. So the seller basically receives nothing for selling their business upfront, but it's paid out over time. So keep in mind, deal structure has a huge impact on overall multiple paid.
Matthias, maybe I'll give you a quick minute here. Cameron asked about the recent SBA changes and the impact on deal making.
Yeah, so I was just scrolling through the questions. Apologies for getting distracted. So the recent guideline changes and impact on deal making, I would say generally speaking, Cameron, a couple things. So one is with the June guideline changes, one thing that happened is if the seller wants to roll any equity whatsoever, regardless of if it's 1%, 5%, or 10%, they have to provide a personal guarantee on the SBA loan for 2 years, after which point in time it goes away. And so what we've seen on Pioneer's side, and Sam and Calder folks, I'd imagine probably similar on your side with SBA deals, is there's not as much of an appetite for these rollover seller equity deals as there used to be before June of this year. Aside from that, the other thing I would say, broadly speaking, is lots of banks are getting more stringent on buyer financial avatar. And so before the June guideline changes, you could have a seller's note on 2-year partial standby followed by payments in year 3 through year 10 as part of the 10% down payment. Now, basically, you can have 2 options for coming up with a down payment. One is having 10% down based on the total use of funds, so the purchase price of the business, plus all of the other deal costs, working capital, SBA fee, deal fees. The other is basically splitting that 10% down the middle, having half of that be cash, having the other half be a seller's note on full standby. And so most banks typically, post-guideline changes, are not as favorable of the full standby, and it's just hard to find sellers that want to do it. And so typically the liquidity requirements of being able to get into the arena to buy a larger size, meaningful business that's transferable have gone up since the start of the summer.
Thanks, Matthias. We do have a couple more for you. So regarding the pari passu and the Anika deal that you worked on, does the person need to demonstrate commensurate personal liquidity?
Generally, yes. There's 1 or 2 banks where they'll look at management experience to kind of effectively offset lack of personal liquidity. But what I would say to answer that question, Alexi, is someone that from a personal balance sheet or personal financial statement would qualify to do a $2 million SBA deal. That bogey is going to be lesser substantially than what a bank wants to see for someone doing a pari passu deal. So what I tell people is a good rule of thumb is over $100,000 of post-close liquidity. And typically speaking, there's going to be some variance based on deal size. So as you go up on the conventional, like if you're going from 1 million to 3 million, they're going to want to see kind of proportional post-close liquidity. Some banks, depending on who you get, will look at collective working capital that's going in the balance sheet to mitigate that, but it's very situationally dependent.
Thanks, Matthias. One more for you. How does Pioneer look at deals that include business plus real estate, where the business is within that SBA parameter, but the real estate makes the full deal worth more?
Run that. Okay, I think I see here. How does Pioneer look at deals that include business, real estate, business? But the real estate's more. So basically, if the real estate plus the business brings it over the 5 million.
Yeah.
So what you can do there, and this was actually the case in Anika's deal, is you can combine them both together as part of the same financing, and you can still look at doing the pari passu. So basically the SBA 7A plus conventional. You can also sometimes look at doing an SBA 7A plus 504 loan. There are multiple ways to kind of block and tackle it, and sometimes situationally depending, if the real estate isn't mission critical to the business operations, so say hypothetically you're buying an accounting firm where the seller just happens to have a building that they'd ideally like to sell with the business, but you as the buyer don't ultimately need it or you're fine punting on it, is sometimes what I'll tell people is look at doing a lease with an option to buy and basically defer the decision on buying the real estate maybe for a couple of years down the road.
Yeah. Can I add something, Matthias?
Yeah,
and
go
for example, if you're buying the business and the real estate together under the 7A, and even if it's above the 5 million, but in the limit of the 8 million pari passu that Matthias mentioned, one thing that it's important to keep in mind is that a business acquisition, you're looking for 10 years of amortization, where real estate, you're looking for 25 years loan amortization. And what they do when you have that transaction combined is if the real estate represents 51% or more on the total project cost, then you can get the entire loan amount up to 25 years amortization, which can be super interesting in terms of cash flow for the buyer. If it's not 51%, if it's less, the way that a lender would, I would say, like typically approach is doing a blended amortization. So it's going to be an average between the 10 years and of the business and the 25 years of the real estate. And based on the proportion, they will find a blended amortization to secure that loan amount.
Thanks, Rafael. I believe we have gone through all of the questions. If I missed a question, Cameron's got one more. Matthias, will you guys partner with clients to best structure the cap table for the benefit of the business, to optimize leverage terms as part of the engagement? So post-close, looking at maybe post-close debt to service coverage ratio, Matthias, is that something included in with your service?
Yeah, let me just read this back. You guys work this. Cameron, I guess is the question from structuring like the fundings or like the sources of fund stack or the equity? When you say cap table, do you mean like the equity investors? Oh, sources.
Sources.
Yeah, so that's the thing that we definitely do. So basically, Cameron, ideally we have people that reach out to us when they're pre-LOI but kind of close on a deal, and that way we have our head of credit Ramiro go through and do a pre-LOI deal review to make sure that the deal structure is ultimately going to work, and so that the client's optimizing the combination of equity and debt and basically not depleting their equity reserves too much, since sometimes on the margin it makes sense to keep extra liquidity on hand if you don't have to put it towards the down payment. So that's absolutely something that we could help with.
Yeah.
Question we frequently receive is whether our fee can be financed or not. And the answer is, when we follow certain steps correctly, yes. So I don't want to say always yes, but we've had no issue with that when we follow the correct steps. Of course, it is part of the loan and the financing, and therefore the amount included in the total loan. The total amount has to work with the debt coverage ratio. So if we were at the extreme of leveraging the business already, then of course we can tack on a little bit more. But again, as long as you're planning for that from the beginning, we've been able to successfully loop that in.
Yeah, and I can confirm that on our end. Basically, you just have to have the right banks involved with the deal. Some banks just don't understand Calder Capital, but we've had success there.
All right. I think that is all the questions. We're at the top of the hour as well. If anyone has any more questions or any interest in working with either of our firms, we've got Rafael's email up here as well as mine and Aidan's. Any other closing remarks from Matthias or Sam?
Yeah, so the only, I guess, closing remarks here from our side is, we're still seeing lenders actively deploying capital. Fortunately, the government is back and open for business, which is great for both of us as well as business buyers. And so I think kind of back to Ben and Sam's opening remarks at the start of the webinar, if you're looking to buy a business next year, now's the time to get started, whether it's helping, like connecting with Calder to get things started on a search, or connecting with Rafael to get things started on a pre-approval, or just going on biz buy sell and cruising around. The famous saying is the best time is now and the next best time is tomorrow. I just made that up. But we're here to help if we can be of assistance. So thanks everyone for joining here.
Yeah, and if I could add just last closing remark, you may see things in the news and in the media about it being a slower time for deal making or private equity struggling. These are true at much larger deal sizes. At the deal size that Calder works on, and I believe Pioneer as well, it's anywhere in that 500,000 to 50 million are most of our deals. We've done below and above that, but that's not the case. It is full blast ahead. We just hit deal closing number 52 on the year as a firm. So there's no slowdown in deals getting done. And I honestly think that it's going to be a very, very strong year next year. And part of the reason I say that is the momentum we have right now on our buy side team. We have over 70 searches ongoing. We have 17 letters of intent currently signed, and we are sending out tons and tons of offers every day that are turning into more signed letters of intent. So don't hesitate to reach out if you have any questions at all. Thanks so much for your time today.
Awesome. Thanks everyone. Cheers.
Thanks everybody.